Welcome to the cutting edge of investing, where data and ethics converge in ESG analysis. Imagine a dashboard teeming with metrics that go beyond mere numbers. Over 90% of S&P 500 companies are already on board, tracking their environmental, social, and governance impacts. But how do we make sense of it all? Enter a suite of sophisticated tools. Data aggregators compile information from diverse sources, while AI algorithms sift through the noise to offer actionable insights. And let's not forget blockchain, ensuring transparency and accountability like never before. The metrics? They're comprehensive, from carbon footprints and waste management to board structures and shareholder rights. These indicators offer a 360-degree view of a company's ethical footprint. And it's not just for show. The EU has laid down a regulatory framework making certain metrics mandatory. But the future holds even more promise. Imagine real-time monitoring through Internet of Things sensors and the decentralization of ESG investment via blockchain. We're not just tracking, we're transforming. So as you invest, remember, you're not just betting on a company's financial performance, you're endorsing its impact on the world. Kevin, I'm not sure if you got cut off there right before we went to the segment.
Well, I just wanted to compliment what Debra was saying about risk by saying that at least in the foundation world, there are multiple tools that can be deployed, and one of those tools is a grant. The other is relationship building and engagement with the grantee, and the third would be an impact investment or a loan or whatever. In the Charitable Foundation's case, as a community foundation, we would deploy all of those tools together, both to enable the organization that we're investing in to have more capacity to actually do the work that it's doing. A good example would be a community loan fund. You provide capital for them to loan, but you provide an operating grant to help them have the staff and the capacity to actually deploy that capital. And then to maintain a strong relationship throughout. And eventually that's where the metrics come back, where you can see directly engaging with that organization how they're performing, and they can report to you and understand better, help you understand the impact of your dollars going to work in that place.
We'll welcome in Laura, who I understand is a recovering banker turned being more purpose-driven. You've really embraced like educating investors. So I'm curious, what has your learning curve look like from student to teacher?
Wow, an amazing question. I think it's been quite a ride and quite a long journey. Can you guys hear me all right? Because there's a little bit of background noise. So basically, my first impact investing course was in 2014, and it was what I say the American version of impact investing. That I think it was a little bit more venture capital with impact in that course. And then I went to Oxford to study the UK or European version. That was much more focused on being the public-private partnerships, the social impact bonds. And I saw some contrasts, but I think back in 2014, all impact investing education mostly came from the global north, and it was mostly in English content. So we were the first impact investing advisory firm that did impact investing courses in Spanish. And so there was this big hunger all throughout Latin America of so many investors, foundations, funds, and so many institutions that really needed and wanted impact investing education. And at first, I was only doing like the introduction of what I considered like the global thought leadership. But then we started doing our own thought leadership. And I think that was critical. I think in order not to be a rebel, but to question a little bit of the investment paradigms and see what could be the evolution that Latin America could bring to impact investing. So for example, questioning the the regular spectrum, the framework of impact investing that starts in philanthropy, saying maximum impact, no returns, and like traditional investing, maximum returns, no impact, and all the shades in between. And we made our own framework, which is a holistic investment spectrum that said, okay, what's the life producing potential of investments? So what investments destroy life? What investments make life survive? And what investments could make life thrive? And so for us, the ones that make life thrive are the regenerative investments. And we started pointing our impact investing education towards a regenerative direction since 2018. And we started following a lot of the regenerative economy thought leadership. And we started co-creating with other impact investing practitioners in Latin America to see what else we could incorporate from the Latin American flavor, like indigenous wisdom, and so many things to question the current investment paradigms and have something that makes more sense to the local communities in Latin America. And I guess that was the beginning of the journey.
It's been quite a journey. Bruno, I want to ask you, since you've really been deeply involved in like screening and filters, like how important are standardized metrics in ESG investing? And then today, do you see things like AI-driven analysis in the ESG space?
I guess the answer is yes to both. So what's been happening with sustainability data or ESG data mirrors what has happened with traditional financial data. So traditional financial data, when I started in the investment business, was not standardized around the world. So Japanese accounting and Spanish accounting, US accounting was all different. And you spent an enormous amount of time trying to make apples for apples comparisons. And then the rise of the Financial Accounting Standards Board and the International Accounting Standards Board and the agreement between them in 2002 has taken us to where we are today, where financial data is highly standardized and coherent around the world. So sustainability data started to be formalized in accounting sense with the Sustainability Accounting Standards Board. I was very involved with the formation of that. And carbon-related metrics really kind of rose out of the task force for climate-related financial data, which I was also on. And now both have been subsumed into the International Sustainability Standards Board. And so what you're seeing now is the emergence of a coherent accounting scheme and a reporting scheme for this data. We're a ways away from having it have the kind of universality and coherence that we see in financial data, but I would say we're 70% along the way. That anyone who uses a standardized ESG data service or has a Bloomberg terminal or anything like that has access to probably more data than you can really use. But there's certainly enough there, and it's industry-specific data, and it's material data that helps you complete your analysis of any prospective investment. So we've come a very, very long ways from a real dearth of data, really messy data, to reasonably well-organized data that's reasonably comparable. Is it perfect? No, but it's way, way better than it was 10 or 15 years ago.
Debra, does the MacArthur Foundation use AI and data analytics in its impact investments?
Certainly, we use what we call impact measurement and management, IMM. That's become kind of the standard concept guiding how investors like ourselves that are doing impact first, catalytic, private investing, how we think about it. It's an interesting question whether AI will become a useful tool. Obviously, we're all of us at least that have not been deeply immersed in AI, we're all in early days of understanding what the new tools might be. But currently, that's not one of the things that we're putting to work. But I do want to give a quick reference to something called the Impact Management Project, or IMP. It now has a slightly different name, but what they did, and this is happening in parallel, probably a little bit of intersection with all the different efforts that Bruno described so well that have led to the ISSB and everything that's happening in that part of the market. But for those of us who are doing, on purpose, quite intentional, quite custom, quite targeted types of impact investing, whether it's venture, as Laura mentioned, you can have venture funds like an Impact America fund, which has layers of impact around racial equity and wealth building and so many other positive impacts in education and health and entrepreneurship. You can have that type of investment. You can be investing in a loan fund, as we've also heard about. You could be financing childcare facilities, affordable housing, and many other kinds of community-based assets. So regardless of which sector you're in and whether you're doing debt, equity, or guarantees, which we also do quite a bit, the Impact Management Project has given us a very distilled framework that came out of discussions with hundreds and thousands of investors of various kinds. You look at what the impact is supposed to be, what is the outcome, who is supposed to experience that impact, how much impact is supposed to happen. Contribution is another word for additionality. Would this investment flow happen without the impact investment that you're making? And then finally, what is the risk that the impact might not materialize as expected? So that 5-point framework can then be applied, whether we're doing affordable housing as a strategy to break the cycle in and out of jail, whether we're looking at solar deployment in India in the small business and commercial sector, whether we're working with Raven Capital in Canada, which is the only Indigenous-led and focused venture fund that we know of today, but there will hopefully be more to come. So we can bring that 5-point framework and then let the impact analysis be quite specific. And I think, we're always looking for the balance so that we're not trying to have the absolute most granular, perfect metrics in the world, because we don't want to overly burden enterprises, nonprofits that may be new, that may be cash strapped. So we're trying to be mindful and respectful of the burden. We're trying to make sure we're collecting data that we really need, that we're going to analyze, not just to collect it, but really think about that question, and to also then share the learnings as we go. So we have major evaluations that are attached to all of our major initiatives, and that includes impact investing. And we have found this framework from the Impact Management Project to be a really valuable tool. There's also something called the Impact Frontiers Project, and that's also trying to come up with a way that you can, across different kinds of initiatives, think about this risk, reward, and impact intersection that we were talking about before.
Kevin, in your TED Talk, you talk about, people ask you, how can they get involved? How can they make a difference? I love hearing all about the analytics, the monitoring, the measurement, but the average person, what should they do?
It's a great question. I am a big fan of keeping my money as local as possible, or at least asking the question before I spend $1 or I invest $1, where can I put this that it will turn over again and benefit my local community? There's a fair amount of research that shows that $1 spent on Main Street of any community in the country in the US is going to turn over 2 to 3 times. So when you spend $5 for a coffee, at least that's what it costs where I am, in your local coffee shop that's owned by a local business person, that person is going to be spending that money for employees, for rent, for sourcing materials and equipment, et cetera, for that local business. So that means your money is multiplying in the local economy. So my first thought is, as much as you possibly can, spend money in your place, because that place will benefit multiple times over. The second is simply to ask the question, I have an investment portfolio, I have a retirement portfolio. I'm asking my advisors, where is my money invested, and what options do I have to think about aligning that money with what I care about? I care a lot about local food. And so when a new mutual bank was forming in the state of New Hampshire, the first one in 100 years, that was going to focus on the local economy, the local food economy, everything from farmers to value-added producers, I wanted in, and I have both an equity investment in that small bank, very small one, but I also keep a deposit account there because that's money that the bank can lend into those small businesses and economic activities that I really care about. And that keeps the money flowing here where I am. So spend your money on Main Street, ask the question where your investment dollars are going and how you can adjust that to align with what you care about.
Great advice. I'd like to move on to segment 3.